Welcome to Professor FinTech, where we break down complex financial concepts into simple, easy to understand explanations. In today's video, we are diving deep into the foundation of all accounting, the accounting equation. Assets is equal to liabilities plus equity. We will cover everything you need to know, from what each component means to practical examples of how this equation is used in a real life. Let's get started. Introduction of accounting equation. The accounting equation represents the relationship between a company's assets, liabilities, and equity. Understanding this equation is fundamental to understanding financial accounting. Let's break this down into simple terms. Assets, liabilities, and equity. Assets are resources owned by a company. Liabilities are obligations or debts owed by a company, and equity is the residual interest in the assets of the company after deducting liabilities. We will provide practical examples to illustrate this definition. Owns or control is equal to owes to external or owner. Importance. The accounting equation is extremely important in finance because it ensures that a company's financial statement remain accurate and balanced. Every business transaction affects at least two parts of this equation, keeping both sides equal at all times. For example, when a company receives an investment from owners, assets increases and the liabilities increase by the same amount. The accounting equation is a fundamental principle of accounting. It states that a company's assets must always be equal to its liabilities plus its equity. In simple terms, everything a company owns, its assets, is financed either by borrowing money or by the owner's investment. This equation provides a clear financial picture of a company's position at any point in time. It helps investors, managers, and analysts understand how resources are funded and how stable the business really is. The accounting equation is also known as the balance sheet equation. It follows a simple rule. The left-hand side must always equal the right-hand side. LHS is equal to RH. No matter how many transactions take place, this balance must always be maintained, and that's why the accounting equation forms the foundation of all financial reporting. Let's start with the first part of the equation, assets. An asset is anything a business owns that has value and can be used to generate income. Assets can be tangible, like buildings, machinery, or inventory, or intangible, like patents or trademarks. Some common types of assets include cash, money the business holds in its accounts receivable, money owed to the business by customers, inventory, goods available for sale, property, plant and equipment, physical assets like land, buildings and equipment, tangible assets, these include intellectual property like trademarks, patents and goodwill. What is liability? Next we have a liability. A liability is what a business owes, its debts or financial obligations. These can range from short-term debts like accounts payable to long-term liabilities like loans or mortgages. Liabilities come in two main types. Short-term liabilities, which also called as current liabilities. These are obligations that company expect to settle within a year, like accounts payable or short-term loans. Long-term liabilities, these are debts that will be settled over a longer period of time, like mortgage or bonds payable. What is equity? Finally, we have equity. Equity represents the owner's claim on the company's assets after all liabilities have been paid off. In other words, it's the value of what's left in the business for the owners after debts are settled. Equity includes things like owner's capital, the initial investment by the owners, retained earnings, profit that have been reinvested into the business, stockholders' equity for corporation. This includes the value of shares held by investors. Let's put this into practice with some example. In the first example, issuing capital, the company issues capital stock and receives cash of 5,000. Assets increased by 5,000. At the same time, equity also increases by 5,000 as shareholders have invested in the business. In the second example, the company buys assets worth 8,000 by borrowing money. Asset increase because the company now owns new property, land or vehicle. Liability increases by the same amount because the company owes money to the lender. In the third transaction, the company sells asset to pay off part of its liabilities. Assets decrease by 500 because assets are sold. Liabilities also decrease by 500 because debt is paid off. In the fourth example, the company buys assets worth 900 using two sources, shareholder money and the borrowing money. Asset increased by 900 in total. Liabilities increased by 400 due to borrowing. Equity increases by 500 because shareholders contributed capital. In this example, fifth example, the company pays expenses or distribute dividends. Asset decreased by 200 as cash is paid out. Equity also decreases by 200 because expenses reduce retained earnings. Finally, the company pays off a debt it owes. Asset decrease by 500 because cash is used. Liabilities decrease by 500 because the debt is settled. When we add up all the transaction, total assets equal to total liabilities plus equity. $15,100, $15,100. Importance of the accounting equation in finance. The accounting equation represents the relationship between a company's assets, liabilities, and equity, and is an important tool for financial analysis and decision making. It allows investors and managers to make informed decisions about a company's financial health by understanding the relationship between these elements. Financial analysis. Well, the accounting equation always plays a vital role in financial analysis. It helps analysts evaluate a company's overall financial performance and health. Financial analysts use the accounting equation by comparing a company's assets with its liabilities and equity. The comparison reveals how the business is financed and whether its resources are being managed effectively. By analyzing this relationship, analysts can determine if a company is financially stable and identify areas where improvements are needed. To assess financial stability, analysts rely on various financial ratios derived from the accounting equation and financial statement. These ratios help measure liquidity, solvency, and long-term sustainability. Through this analysis, analysts can determine whether a company is financially sound or facing a risk of bankruptcy. In simple terms, the accounting equation provides a clear picture of a company's financial strength, helping analysts, investors, and managers make informed and confident decisions. Decision making. Resource allocation. Managers use the accounting equation to understand how a company's resources are structured, asset, liability, and equity. This helps them decide where to allocate resources efficiently, ensuring money, equipment, and manpower are used where they generate the highest value. The goal is simple: maximize profitability while increasing shareholder value. Next comes investment decision. By analyzing the accounting equation, managers can evaluate how company assets should be invested. Should they expand operations, invest in new technology, or enter new markets? The equation helps balance potential returns with risk, guiding smarter investment choices that support long-term growth. Finally, debt and equity decisions. Managers rely on the accounting equation to decide whether to raise funds through debt or issue equity. Taking on debt can boost growth, but it also increases financial risk. Issuing equity reduces debt pressure but may dilute ownership. The accounting equation helps leaders strike the right balance between risk and reward. In the conclusion, to conclude, the accounting equation is more than just an accounting rule. It's the foundation of a financial understanding. It helps investors and managers clearly see how a company's financial resources are allocated. By understanding what assets represent, how liabilities create obligation, and how equity reflects ownership, decisions maker gain a complete picture of the business. This relationship allows them to make informed decisions, from investing wisely to managing risk to driving long-term growth. In the end, when this equation is understood and applied correctly, it becomes a powerful tool for building a stable, successful, and growing company. If you found this video helpful, don't forget to like the video, subscribe to the channel, and turn on notification for more finance concepts.